Hello everyone, in this video we will learn about the statement of owner's equity. The purpose of this statement is to show how each equity account changes during the year. Equity means the owner's claim on the business. It is usually presented in a columnar format. This means that the columns represent the different equity accounts. For example, one column for common stock, one for additional paid-in capital, one for retained earnings, one for accumulated other comprehensive income, one for treasury stock, and finally, one column for total equity. The rows show the movement across the year. At the top row we write the beginning balance. Then, we add or subtract the changes that happened during the year. At the last row, we show the ending balance. Now, here is the important connection. The ending balance of each account in this statement is reported again in the equity section of the balance sheet. For example, let us take retained earnings. Here in this statement, the company began the year with retained earnings 3,540. During the year, it earned profit, that is 3,689, and declared dividends, preferred dividend 5 and common dividend, 1,023. The profit is added and the dividend is subtracted. The beginning balance of year 20x1, that is ending balance of previous year, 3,540 plus net income or profit, that is 3,689, minus preferred dividend 5, minus common dividend 1,023. The result is the ending balance of retained earnings, that is 6,201. That ending balance is shown in the statement of owner's equity, and the same figure also appears under retained earnings in the balance sheet. Let us also see common stock. This company issued new shares during the year. In this statement 20 new common shares are issued. In the statement of owner's equity, you will see the beginning balance of common stock, then the addition for the new shares issued, and finally the ending balance. In this statement the beginning balance is 1,650 and common stock issued is 20. So ending balance in common stock will be 1,670. That ending balance will appear as common stock in the balance sheet. So, the statement of owner's equity acts as a bridge. It explains how net income, dividends, and stock transactions affect the owner's equity. And, it shows how the figures in the balance sheet are actually built up during the year. Now that we understand the connection between the statement of owner's equity and the balance sheet, let us look at the flow of changes during the year. The balance sheet shows equity at a specific point in time. It is like a snapshot. You see the ending balances for common stock, retained earnings, and other equity accounts. The statement of owner's equity, on the other hand, explains how those balances changed during the year. It tells the story of what happened to the owner's claim on the business. Here is the usual flow in the statement. 1. Beginning balances. This is where the year starts. You list the balance of each equity account from the previous year. 2. Net income. When the company earns a profit during the year, it increases retained earnings. Think of it as adding money to the owner's share because the business earned more. Example: if the company made a profit, that profit is added to the retained earnings column. This shows that the owner's claim has grown because the business earned money. 3. Stock issuance. If the company issues new shares, the common stock column increases. This is new money that owners or investors have paid to the company in exchange for shares. Example: imagine the company sells new shares to investors. The money received is added to common stock and possibly to additional paid-in capital, showing that more owners now have a claim in the business. 4. Dividends. When the company pays dividends to its owners, it reduces retained earnings. This is money going out of the business to the shareholders. Example: suppose the company pays some dividends during the year. The retained earnings column decreases because some of the profits are given back to the owners. 5. Treasury stock. If the company buys back its own shares, the treasury stock column increases, which reduces total equity. This shows that the company is using its own money to buy back ownership from investors. Example: the company buys back some of its shares from the market. The treasury stock column increases and the total equity decreases because some ownership has returned to the company itself. At the end of these changes, we calculate the ending balances. These ending balances are exactly what will appear in the balance sheet. So remember, the balance sheet is a snapshot of the equity at the end of the year, while the equity statement is the story that explains how we got there. Beginning balances start the story. Net income adds to retained earnings. Stock issuance adds to common stock and owner's claim. Dividends reduce retained earnings. Treasury stock reduces total equity. By looking at the statement, you understand not just what the balances are, but how each component contributed to the change during the year. Now let us learn about the notes to the financial statements. According to accounting standards, such as ASC 235 and the Statement of Financial Accounting Concepts No. 5, the notes are considered an integral part of the financial statements. This means they are not optional. They are necessary to properly understand the balance sheet and the income statement. The purpose of the notes is to amplify and explain the figures shown in the financial statements. While the balance sheet and income statement show the numbers, the notes provide the story behind those numbers. The information presented in the notes must be relevant, reliable, and measurable. In other words, the notes should give users useful details, be based on sound data, and be capable of being verified. Now let us see some important examples of what the notes include. First, impairment losses. If a company has an asset, such as machinery, and its value drops permanently because of damage or market conditions, the company must record an impairment loss. The note will explain why the impairment happened and how the company calculated it. Second, depreciation and inventory methods. The financial statements show only the final numbers, but the notes explain the methods used. For example, the note may explain whether the company uses straight-line depreciation or an accelerated method. Similarly, for inventory, the note will state whether the company uses first in, first out or weighted average. This helps users understand how the numbers were derived. Third, revenue recognition. The notes describe when and how the company recognizes revenue. For example, a software company may state in the notes that revenue is recognized only when the service is delivered, not when the payment is received. This gives clarity about the timing of income. Without these notes, the financial statements would be incomplete. The numbers alone cannot give the full picture. The notes provide the details, the methods, and the reasoning that make the financial statements understandable and trustworthy. So remember, the balance sheet and income statement show the financial results, but the notes explain how those results were produced. Together, they give a complete and transparent view of the company's financial position.